Yes. So a very good evening to Yash Bhaiya and all the participants that are present in the webinar. So we have 20 participants that have joined us till now. So myself, CS Sukrit Sinha, practicing chartered accountant based in Kolkata. So I will be today's moderator for this session. So today's session is finalization of books of accounts, which will be deliberated by Mr. Yash Dhadda. So to introduce him, he is a fellow member of the Institute of Chartered Accountant of India, and he is associated with Messrs. Dhadda and Co. as a partner in indirect taxes, which is a part of ICI registered network as DSM and Alliance. He is having working experience of over 13 years in the field of indirect taxes with concentration only on GST, service tax, and excise matters. He is currently engaged in handling litigation along with advising clients, structuring transactions, and conducting due diligence in the fields of taxation. He was a special invitee to the Indirect Tax Committee of ICI for the term of 3 years, that is 21-22, 19-20, and 18-19. He is also on panel of CII Rajasthan as GST, Service Tax, and Excise Advisor for the industry members. He has represented ICI in Regional Advisory Committee, Rajasthan, under aegis of Chief Commissioner of Excise and Customs, Jaipur. He is the founding core member of study group of ICI on GST research and upgradation matter. So apart from his professional qualifications, so Yash has also deep interest in academic discussions, upgradations, and training. So he has written handbooks on principles of classification of goods and services under GST and also on CTP for ITDC of ICI. He has also actively contributed as core member of the team, which has drafted a technical guide on GST audit issued by ICI, which was our helpline when first GST was introduced and GST audits, we were conducting the GST audit. So he has delivered lecture in across India and is also a regular attendee of various study courses on GST conducted by the BCAS, CTC, ICI, and other forums as group leader and coordinator. He is an impaneled trainer on GST for the NASIN, ICI, and Regional Training Institute for Revenue and CNGG officers and Rajasthan SGST officers. As his passion, he is also engaged in grooming young professionals of CA, CS, and MBA on topics of soft skills and professional life management. With such distinguished background and achievements, I am sure that this session would add valuable knowledge insights for us. With this, I would now like Mr. Yash Dhadda to take over the webinar and proceed with the topic.
Thank you so much, Sukrit, for this warm welcome and introduction. First of all, at the outset, I would like to thank ACA for giving me this opportunity to be part of this certification course. And if my memory goes right, I think this is for the third time I'm being part of this certification course. So every year it is a pleasure for me to be a part of this wonderful initiative by the organization. When I was going through the topics, and interestingly, today's topic, though it is a litigation series and it's a certification course on the topic of litigation series under GST, my topic is slightly different from the per se litigation or the hardcore litigation which is basically supposed to be undertaken. And rightly so, I understand it has been kept appropriately because the topic is finalization of the books of account from GST perspective. That is to say that at the inception, when you're actually looking at the books of account, when you're finalizing them, what are those key points which you should consider? What are those basic precautions which one can do at the end of the year so that when you are facing a notice, when you are into an actual dispute with the revenue or when information being called for, that information is readily available with us. At the same time, we are able to understand and gauge as to what extent and what is the purpose for which the information has been sought. So today, in this course of 2 hours or so, to the extent that we proceed, I will not be restricting myself only to the topic of litigation per se in this subtopic which has been given to me, but it will be more on the compliance perspective, more on the perspective of that when you're looking at the books of account from a chartered accountant's perspective, or somebody who's actually looking it from a purely accounting perspective, at least in terms of a regulatory compliance, what one can take care of when you're looking at the subject of GST. I always say that the first slide which you see on my presentation is something which I have thought of keeping it constant, though it says that it is loading. That is in terms of this law which is yet to settle down. It is in the process of settling down, and in fact, what has happened in the last GST Council meeting is in fact kind of a clear direction that it will take some time that this law has to settle. Now, before I go to the topic, I thought of that let us look at somebody who is not purely into litigation, but somebody who is taking care of the books of account, somebody who's into advising the clients, and how do they see GST from their lenses. So I thought of bifurcating into three different expressions. One is the expression which a client would have. So when the GST was implemented, this is the expression which probably all the clients had. All of them were very happy, very jovial, and in fact, to be very honest, though all of us may say that it is very complicated, at the heart of it, when you would ask any businessman, he will say that GST in that sense is far better than whatever indirect taxes we had prior to 1/7/2017. Purely from a cost perspective, it has saved a lot of cost in terms of the cost of doing the business. Maybe the compliance cost would have gone high, but at least the cost of doing business has come down substantially. Now, but because when GST was implemented, that was the client's perspective, because he was not aware of that the implementation is actually on the GST portal. And unfortunately, the portal was not working properly. And today also, there are a lot of issues for which we do not have an answer. You open the law book and you try to find an answer, but you can't do that. And then you go to the GST portal and try to look a different side of the answer. Then you see that in a certain manner, the portal behaves. Yet all of us, if today let's say we are in the seventh or eighth year, and when you're standing here, all of us have tried to accommodate ourselves, adjust ourselves as to how portal is behaving. At times we have actually overlooked what law is the how law is written, but we have gone ahead and worked in a manner as to how GST portal is responding to a certain situation. But when department issues a notice, that is the department's expression. I mean, that's where probably all of us from December 2023, or not December 23, but from September 2023 till today, all of us have faced notices for 17/18 financial year section 73, 18/19 financial year section 73, 19/20 financial year section 73, and 17/18 financial year section 74. At least these deadlines are gone. Orders for at least 17/18, 18/19, 73 done and dusted. 19/20 it will be done by 31st of August. And 74, I'm sure if you are again into some sort of a GST practice, you would have seen a barrage of notices from DGGI, anti-evasion for 17/18 on the last day when the time limit was about to get over. And at least that's what department thought of. And when you stand today in 2024 and look at 17/18, probably at the time of 17/18, nobody had any idea what it will lead up to. And today, when you see the notice and you go back what has been done in 17/18, a lot of it you would say that because at that point of time, none of us have an idea. But now, when the notice is being issued, all of us have some idea what has happened. And that some idea today is kind of actually influencing the department in issuing the notices for 17/18. And to some extent, we are also influenced to say that yes, there was an error which was done in 17/18. Now let's look at what is the recourse available. And that's why all of us are quite happy with the kind of a amnesty scheme which we are talking about under section 128A. Okay, we are having that scheme. Let's go and talk about it. So my job right now today is just from this past, we get to learn something, and that's what wise people do. And from that wisdom which all of us have had in last 7 years, I thought it makes sense that today, if somebody who is finalizing their books of account, and if I say today, probably for financial year 23/24, What are those things which you should take care of so that tomorrow when you will receive notice, let's say next 3 years or next 5 years, so when you will be standing at that point of time, the efforts taken today, slight precautions done today, and an extra work done today in terms of reconciliation may really help us. Okay. So there are three, four types of tasks in terms of, yeah, at least from a law perspective or from a GST perspective, one has to do. Some are compliance related that needs to be done at the year end up to a certain time, which is given in the law. That is from 31st of March, maximum up to 30th of November. You are supposed to undertake certain activities. Some are in relation to input tax credit, where you might have to do certain reconciliations and you might have to take a certain decision also whether you really want to claim that credit or you don't want to claim that credit. Third, and in GST, as we say, that this law is synonym of the reconciliations. So no doubt reconciliation would always be there. And what are those reconciliations on an annual basis which you should do? Some of the reconciliations law mandatorily asks us to do. That is when we file our annual returns, that is GST 9 and 9C. However, beyond that, should you really take up certain reconciliations on your own at the time of finalization of the books of account, and whether that would help or not? And last, fourth is the law related, where generally when we meet in any conference, when we attend a lecture series like this, generally we talk about the law related aspect, the matter of interpretations. So that's the fourth related aspect that one has to consider and think of doing at the year end, where you are taking a position, where you're taking a decision, in a sense to say that you want to look at this side of the interpretation or that side of the interpretation of the provision of the law. So let's try and mix all these four of them together. Let's see that what are those things which are procedural, but still procedural. What is the impact it has when you receive a notice, and what are those things which you can really take care of? First and foremost, very simple, looking at your aggregate turnover at the end of the year. So it gives you a way forward that what you are supposed to do in the next year. Because in GST, there are certain aggregate turnover limits. And mind you, when we're talking about aggregate turnover, we are not talking about a turnover in your books of account, which you call as your books, the turnover as per your books of account. We are talking about an aggregate turnover which is defined under GST, which tells you to include taxable, exempt, nil rated, zero rated, non GST supplies. It also tells you to include certain things which may not be part of your regular books of account, but because of the deeming fiction, specifically your Schedule 1 supplies, it tells you to include all of them. And then on the basis of, and not only it tells you to include on the basis of your GST number, but it tells you to include on your pan India basis in respect of one pan which you have, accumulating the turnover on that basis. And from there, if you reach to a certain number, it tells you or it guides you to take certain decisions or actions on the basis of it. So let's say in a particular financial year, your turnover is up to 50 lakh rupees only. Then next year, and if let's say you are a service supplier and you are under the composition scheme for service supplier, then the question is, you really want to continue in the next year or not? In case you want to do it, then there is a separate procedural compliance that you have to take, wherein you will opt for a composition scheme for a service supplier, or if you've already opted for it, you would like to continue in it and you would not like to opt out for it. Obviously, there is a specific tax rate of 6% applicable, and you're not entitled to take a credit there. Then there is a next limit up to 1.5 crore rupees, where it's a composition scheme for all those under section 10, for all those who are not purely service suppliers, but who are maybe manufacturer goods or trading of goods, or maybe doing manufacturing and trading along with certain supply of services. There, if their turnover was up to 1.5 crore rupees in the current year, whether for the next year again they want to take that benefit of composition scheme, where they would pay a tax at a certain rate of 1%, 5% as may be applicable, without claiming any input tax credit, without going into that monthly jhanjat of filing of GSTR 133 and all those things, but filing one specific form, paying tax there and remaining happy there. If you go to a little somebody who, all of probably these two are all small suppliers, you go to a little bigger one, somebody having a turnover up to 5 crore rupees, there for them up to 5 crore rupees, who are not under a composition scheme or but a regular taxpayer, there, because they have an option to decide whether they want to file their returns on a quarterly basis or a monthly basis, there is a specifically QRMP scheme for them. And in that scheme, whether they want to continue to opt for it, that's the decision they have to take. And second, again, because up to 5 crore rupees there is no e-invoicing, so they don't have to comply with the e-invoicing, but their HSN codes, at least up to 4 digit, they have to ensure that they are complying with the HSN code compliances or not. And we'll come to HSN code in a while as to why on a yearly basis it is something which is very relevant, that one should take up that exercise specifically when you're finalizing your books of account. So that's up to 5 crore rupees, majorly to decide whether they want to do their compliance on a quarterly basis or on a monthly basis. Somebody who is beyond 5 crore rupees, there actually that basket opens up for some who is a medium or a small or medium or probably a large entity, in a generic sense to say that there, if the turnover is beyond 5 crore rupees, then whether they obviously they have to compulsorily opt for e-invoicing. So they have to ensure that up till 2023-24, from financial year 17-18 up to financial year 23-24, in any of the financial years, if their aggregate turnover has crossed 5 crore rupees, then from 24-25, they have to opt for e-invoicing. They have to get themselves registered on the e-invoicing portal. They have to enable the e-invoicing schema for them. And then they have to decide whether they want to basically opt in for e-invoicing through a private service supplier for this e-invoicing, or they want to use the government facility there. And somebody who has a turnover beyond 500 crore rupees, apart from the regular e-invoicing for B2B, which is applicable for them, they have a B2C e-invoicing provisions which are applicable for them. That is the QR code for B2C supplies, which they do, which is kind of a static QR code for in respect of B2C supplies. So this is whenever at the year end, when you finalize your books of accounts, when you have taken care of all 12 returns of a monthly basis, or let's say if you are into quarterly return or into that composition scheme, you have filed it, you have your turnover limits decided, and then you are looking at for the next year that what are you supposed to do, whether you want to continue in the same scheme, if you have an option available to opt out of the scheme, whether you want to opt out or not. So that's on the basis of an aggregate turnover of a particular year, that on the basis of which you take a decision. Now, from this, we come to e-invoicing. And generally, all of us know that e-invoicing as a concept, it has come out, it has come off quite well. In fact, it has been a huge success. If you look at it from the implementation perspective, there has not been a lot of transition issues for all those who are coming into e-invoicing, except barring for all those people who might have missed the bus, who might have missed the compliance of e-invoicing, who are not aware of, who are caught napping. But there also they have at least done the compliance on a overall basis. Now, when you look at the e-invoicing that needs to be done, or somebody who is already doing it, or somebody who might has to do it for the next year, at the end of the year, why it makes sense to actually understand that what has happened in the previous year, or what has happened in that particular year which we are closing. Raising this question because, or I'm raising this point because when you look at it from an overall perspective, what happens is when an invoice is actually generated through your ERP, then earlier it was only registered in your ERP, and from that ERP you were using some third party service supply, third party IT professional facility, or maybe you are using the government utility to put it on the GST portal in GSTR1. Now, between that, we have an e-invoicing portal also, through which again you are communicating, either again through a government facility or through a third-party supplier. And on the basis of it, you are punching your invoice details on a real-time basis on the government portal, that is the e-invoicing portal. Now, once that loop happens, or once that activity happens, your GSTR 199% or 99, maybe too exaggeration, but maybe at least 90% of it is auto prepared. You don't have to punch a lot of details there. And then the ball goes to the recipient side of it, where he has three decisions to take when those details are available. If it is there in his system, the invoice is there in his ERP and appearing in his 2B, it will claim the credit. If it is not there, he will have a time until 30th of November. And if it is not there in the GST portal, that means if you have not done your invoicing proper, then in that case, it will not appear in his 2B, and then because he would not have filed in GSTR1, and the credit cannot be claimed. Now, once I say this, it becomes important at the year end. You look at it from a compliance perspective, that why this compliance has to be smooth. So somebody at the year end who had faced a lot of challenges, or somebody at the year end who did not have a control over this e-invoicing, both from a supplier perspective and a receiver perspective, it is a good time for them to take a step back and understand that there are two, three things that needs to be understood. One is, if they have an aggregate turnover beyond 100 crore rupees coming from the GST portal, then they have an outer time limit of 30 days. That means they cannot falter. Falter in a sense, if I have missed the e-invoicing deadline from an invoice date and my turnover is beyond 100 crore rupees, system will not allow me to generate an e-invoice for a period going back beyond 30 days. So that becomes a problem. Now, what happens if I don't do that? If that has happened, if I don't do that, still I may be able to punch details in GSTR1, but still it will be an invoice which will not be an e-invoice, which will not have a IRN. If it will not have an IRN, the problem is, as per the provisions of Rule 48.4 of the CGST rules, it may not be a valid invoice at all. Now, if it is not a valid invoice, tomorrow recipient might have a problem, and department at his level may raise a question to him by saying that you have claimed credit on an invoice, which is not a proper invoice in accordance with the CGST rules, and hence we may not allow you to take the credit because it is a non-compliance of section 16(2)(a), that you should be in possession of a tax invoice or any duty paying document, and it should be a valid tax invoice. And because your invoice does not have an e-invoice or IRN code, it is not a valid tax-paying document. So that procedural issue comes up. That's point number one. From a supplier perspective, because you are supposed to do the procedural compliance properly, you have to issue the documents properly. If you don't do that, there can be a penalty under 122, which the department may propose. And in fact, we have seen some bizarre instances where, if let's say I've issued 100 e-invoices, or sorry, 100 invoices in respect of which I was supposed to issue e-invoice, department has gone ahead to issue a show cause notice under section 122 for a penalty of 10,000 rupees in CGST, 10,000 rupees in SGST for each invoice. That means 100 into 20,000 rupees, a bizarre show cause notice of saying that section 122 compliance has not been done. Clearly, that's a separate issue, probably if not for me yeah, not for me today to basically answer on that point, whether that could be a proper compliance or not, but at least you are exposing yourself to that risk. Second, if let's say a de facto, post facto compliance is done, that is to say, if your turnover is less than 100 crore rupees, there today, as on date, e-invoicing portal does not give you that restriction of 30 days time limit. So you may go ahead, issue e-invoices for all the previous periods where you were supposed to issue, but you have not done. Still, there is a challenge that at the recipient side, department may raise a question by saying that it has become a valid invoice after a particular date, and hence any credit claim before that may not be proper. All of these are litigations, which is a frivolous litigation. That litigation may at the end of it settle in your favor. But because if the volume is huge, there is a possibility that the number of the amount of that notice may be a little on the larger side. And it will be just because the e-invoice implementation was not proper. Then there is one more issue, that the e-invoicing implementation is not proper. You were supposed to issue an e-invoice, and tomorrow, if let's say the vehicle is intercepted, then in that case, the department officer at least the mobile squad can proceed to issue to do the proceedings under section 129 to raise a penalty up to 200%. Again, that could be valid or not. All those things, that's a separate issue. But today we are not on the point whether that notice is valid or not. We are on the point, can we avoid all those instances where all these types of notices are not issued? So if we realize that yes, on the procedural aspect of it, e-invoicing implementation may look very simple, that if I have done it. But it is very important to have a look at the system, to do an internal audit, to see whether your system is well equipped. Wherever a tax invoice has to be issued, system would give a flag to it that it needs to have an IRN. Wherever a GST debit note has to be issued, system would give a flag that it has to have an IRN. And wherever a GST credit note is issued, again, system would give a flag that it needs to have an IRN. That's from the supplier perspective, where I see a lot of people take care of it. From a receiver perspective also, year-end is also an exercise. Year-end is the right time where you look at all your suppliers, where you have your suppliers fixed. You have their GST numbers, where you can take those GST numbers, go to the NIC website, or you can go to the e-invoicing website, and look at all the new suppliers who are doing business with you for the first time in this year. Go and check whether e-invoicing was applicable for them or not. And NIC comes out with a list. NIC comes out with a list every year, or not in fact every year, every fortnight rather, where it comes out with a list that all those suppliers or all those registered persons who are required or compliant, or who are basically you have to do the e-invoicing compliance. At the year end, what needs to be done? As I said, the action points which has to be there. See whether if you are not in the e-invoicing regime, whether you have to comply with it or not, whether you have to comply in the previous or going forward. Second, e-invoicing has to be automated. It cannot be a manual exercise. If you're doing this manual exercise, actually the whole purpose of having an e-invoice from the government perspective is getting defeated, because the purpose of this is, if you're using an ERP, from that ERP only, once the document is punched into the machine, that machine readable document, it has to be in a manner that it can travel up to its destination without having a human interface. So if you are punching in the ERP, then taking the details, putting into an Excel, and then putting in the e-invoicing portal, I don't really think that's the purpose of actually having an e-invoice. Next, though e-way bill compliance is not mandatorily to be done along with the e-invoicing, but again it is suggested, and that's where a lot of people actually ensure this aspect, that once my e-invoicing is automated, my e-way bill compliance is also automated. That is to say that whenever I'm dispatching the goods, my ERP should be equipped enough to see to it that at the time of dispatch, e-way bill is prepared automatically. So that's the next aspect that needs to be taken care of the year end, to see that how that activity has happened. Fourth, where lot of us actually alter, or at least we don't take care of, but again thanks to departments availability of data which they have with them, all of us have seen notices from the department for financial year at least 18, 19, 19, 20, where they have said duplicate e-invoices, duplicate e-way bills have been prepared, or you have made a supply but e-way bill has not been prepared, or the value on e-way bill is not matching with the invoice. That is because at that point of time there was no checking on the e-way bill portal for a particular invoice, I am generating a double e-way bill or not. Now that we have seen the notices, we understand that your e-way bill reconciliation with your tax invoices has to be there. And again, the answer to that reconciliation cannot be a manual exercise. It has to have an automated system where you're generating your e-invoice and then your e-way bill. So that's the next step that needs to be done at the year end. And fourth is, at least if in case you can send a communication to all your customers so that they are also upright, they are aware of it, that if you are, how are you doing the compliance, if you do the compliance or not, a communication can be sent in that regard. From a receiver's perspective, it makes a lot of sense actually to send a notice to all the supply, or letter to all the suppliers, that if the e-invoicing is applicable on them and they have not complied with it, at least for the invoices raised in the current the financial year for which the finalization is done, they should actually raise the e-invoice within a given point of period of time. If not done and tomorrow a notice is received by you, then the financial burden of it will not be borne by the recipient. I think that is one advice which we can give to all our clients who are the recipients from various suppliers, maybe the bigger or the smaller suppliers, where they give a generic email to all their suppliers that if the e-invoice compliance has to be done, you have to do it. And if you don't do it, and tomorrow if I receive a notice for non-compliance with the ITC from my side, then you will be the person who will be responsible for it, because I had already sent a communication to you. One more thing which I noticed, at least in terms of while looking at the compliances, is we see a lot of invoices with having a QR code and all those things, but when you actually go and scan them, you realize that they are not scannable, or a scanner would not read it. And effectively speaking, if a scanner is not able to scan that details of e-invoicing from whatever valid application or mobile application which is there, then in that case it is not a valid e-invoice, because that the purpose of having that barcode is there, that you should be able to basically scan that barcode. So again, there has to be standard SOP where on a random basis the auditor is taking care of all these things. Now I link this with one more topic at the year end that one should take care of, that is HSN codes. Generally in GST, we know that we have HSN codes both for goods and services. However, still today, majority of us, when we are classifying anything as goods and services, we are classifying them on the basis of the description. Like for example, I will have a product in front of me. I will look at the product. I will ask its generic name. I may ask its technical name. I will go to the rate schedule. And first thing which I will do is I will do Control F. That is, I will go and look at the PDF and I will try and write the description, and then on the basis of the description I will see to it what is the HSN code. If I want to reconfirm that, probably I'll go to the GST website and see that it is it same. If I want to take extra precaution, I may go to Google and see cross check whether Google also gives me the same answer or not. If I'm little technologically friendly, I'll go to the chat GPT or AI also and see to it what is the answer which is being given by the AI. Unfortunately, all of this is a wrong practice or wrong exercise of classifying anything as goods or services. The correct way of doing it is actually on the basis of when you're classifying anything as goods, the principles of classifications given in the customs tariff. And when you're classifying anything as services, for that the reference has to be taken from the United Nations Central Product Classification. And both these things, at least in terms of what is the guiding principles for classification given in the customs tariff, that is mentioned in the rate notification, that is 1/17. And for services, there is one press release which has been issued by CBIC to say that how classification has to take place. Now, generally, during the course of doing the activities on a yearly basis, it may be very tedious, or at times it may be too much to expect from somebody who's doing a data punching to immediately identify what is the correct classification. So generally, we proceed with whatever way of identifying the classification has been done. But mind you, this law in terms of classification is governed by the HSN codes. Okay. Now, this is one classic example as to how the classification is done. When you will look at the rate notification, you will find 2008. Let's say we are looking at the classification of a cashew nut, which is a processed cashew nut. Okay. So what you will do, you will write cashew nut. If the rate notification will show you cashew nut, you may decide that's the classification. Unfortunately, that's not how a classification is done. The customs tariff will tell you that first of all, find out the chapter. From that chapter, go to the heading. From heading, go to the subheading. Then go to the tariff item. Wherever you will have a dispute, compare two comparable headings, compare two comparable subheadings. And there also, if you have a problem, compare the dashes. And you will see in this rate notification, this tariff notification, you will see a single dash and a double dash on your screen. Okay. Now there is a principle to basically decide what will come in the double dash and what will come in the triple dash, whether two double dashes are comparable, whether a single dash is comparable or not. And all of that is written in the customs tariff, which is applicable on the notification for goods. I'm saying this because what happens is generally we have, once we decide a classification, it is very difficult to change the classification. Because once your customer has accepted an invoice, once your system has fed a particular HSN code and a description, once you're filing your returns, tomorrow after 2 years, if somebody comes to you and tells you, no, your classification is incorrect, everybody will make an effort to say, no, my classification is a well thought of classification and I will not change it. Now, we have seen cases where, let's say, my rate of tax is same due to whatever classification is there, but my HSN code is different. And unfortunately, mobile squads or the e-waybill or during the course of movement, all these people, they have this the tendency of saying, because the HSN classification is also incorrect, we will intercept the vehicle. So that's where it is at the year end, it is the right approach to basically look at and identify that classification in terms of goods is not on the basis of description which you see on your rate notification, but it is on the basis of how will a particular HSN be arrived at on the basis of the customs tariff. Okay, you come to services, and services is even more interesting. Services, where there is an explanatory note which is given to the classification of services somewhere in 2017 October or September rather. There CBIC clearly said that in terms of services, the classification, the supremacy has to be of the description of the service but not of the HSN. So it's a completely opposite stand in terms of goods and services. So maybe you might have taken a call by saying, okay, I will look at everything from an HSN perspective, but that's not how it is. Your services classification is based on the description. Your goods classification is based on the HSN. What will come in the HSN is in terms of goods is derived by customs tariff. What will come in your services classification is determined on the basis of the description. Now, let me give an example to you. I have just put three rates. Let's say in terms of a GTA, you want to pay tax, or let's say you are into business of doing transportation of goods by road. There are two HSN codes, 996511 and 996791. When you read both of them, 996511 says road transport services of goods, and 9967 says goods transport agency services for road transportation. Okay. Now one might say, where will I fall? 9965, 9967. Maybe on the description of it, you will say 9967. On a generic term, somebody would say 9965. But again, when this sort of situation is there, it says go to the explanatory notes. When you will go to explanatory notes, 9967 it falls under other supporting services. 9965 is like when somebody is actually himself or themselves taking the transportation. Practically, for all the exemptions which somebody has to take, if let's say if I am not a GTA, then all of us know transportation of goods by road other than GTA is exempted. Okay, so 9965 is that category where all sort of transportation is covered. If somebody is providing a support to GTA just by arranging a bill T, then that falls under 9967, and all of that on the basis of description. When you read the explanatory notes, that is mentioned there. So what I'm trying to say is year end is the correct time where you go back, look at it, that if you're doing a classification, why are you doing that classification? At times, it may sound little absurd to say that every year should I do this exercise? Well, my advice would be that yes, specifically if you fall into a rate category, which is not the standard rate category of 18%. If you're using a rate category of 5, 12, or maybe any other rate, it every time it makes sense to basically go back and revise to it at the year end and whether your HSN is correct or not. Let me bring one more example here as to why it is important. Let's say somebody is into transportation of a passenger by vehicle. Now we have two HSN codes, 9966, 9964. One is a transportation, which is 9964, and one is renting a motor vehicle, which is 9966. There is a reverse charge applicable in terms of in one of two, and that reverse charge is there in 9966 if I am a non-body corporate supplier and my receiver is a body corporate, and if my service is renting a motor vehicle, it is 9966 where tax has to be paid by the recipient if I am not charging tax at the rate of 12% on my invoice. Whereas in terms of transportation, there is no reverse charge at all. So if I'm a body corporate, non-body corporate, my recipient is a body corporate, non-body corporate, does not make a difference. It will always be under forward charge. But it can be 5%, 12%, that is there in the rate notification. Now, what are the attributes of a renting and what are the attributes of a transportation? They're altogether different. Transportation is on a predetermined route, predetermined time, whereas renting is not predetermined route, but it is on the possession of the rentee. This is somebody who's taking on renting. One of the credit is blocked, one of the credit is not blocked. Renting credit is blocked, transportation credit is not blocked. So again, year end, as we are closing, and the purpose of telling you all of this is maybe what we might have been doing an exercise on regular basis. If let's say not from the supplier perspective, from a receiver's perspective, go back, look at your books of account, try and find out if you're actually paying tax and a reverse charge on renting, whose credit is blocked, and you have to do the compliance and see to it whether the transaction can be restructured into transportation where you don't have to pay tax and the reverse charge and still the credit is available to you. So that's the purpose of basically saying that this HSN compliance needs to be taken care of the year end. Now, if you combine e-invoicing and HSN together, it's a landmine, it's a gold mine of information which is available with the revenue. Why? Because if some of you would have actually seen the process as to how e-invoicing is implemented, your e-invoicing, when your software picks the data for the purpose of e-invoicing, it picks the data from the stock masters. Okay, it will not pick from the account master, it will pick from the stock master because it has to pick the stock item. Okay, now once it has to pick the stock item, all of us have different stock items. In a sense to say, if let's say I'm selling a shirt, I might have 100 categories of shirts in my stock item. Red color this size, blue color this size, this inch, this fabric, and all those things. Now your e-invoicing is designed in a manner that if it is automated, it will pick the data from that particular stock master. Now, what is happening is that is getting printed on the e-invoice. That data is getting uploaded on the e-invoicing portal, and your rates of a particular blue color shirt where you have five different types of, let's say, rates. Rate. I'm not talking about GST rates, but I'm talking about the rate at which you're selling to the customer. That is available. So basically, what you're doing is you're exposing your description, you're exposing the quality, and you're exposing the rates applicable against all of this. Today government is not tracking that data because they can't do that because it's a very voluminous data. Plus somewhere also what happens is after 3 days this data goes on the back end of the government. That means the data is not available on the forefront. But today they are not tracking. You don't know whether after 2 years, 3 years they will start tracking it. And once that tracking will start, then in that case practically what is happening is your outward classification, stock reconciliation with your whatever values you're putting in your GST return, you yourself are submitting to the government, where government is keeping a record of it or their database is keeping a record of it. And tomorrow you might have a notice by saying as to why your books of account are fluctuating, irrespective of considering the fact that the composition of your supplies have not changed. So the purpose of saying this is that year end again is a time where you try and look at it, your description of goods and services which you have in your master, look at it from that particular master, what is getting picked and going on the e-invoicing. Check that your HSN codes are not on the basis of pure description, but in terms of goods, it is on the basis of the customs tariff. And from the services perspective, it is from the description perspective. Then further going into explanatory notes, then only your classification is proper. Same applies for your inward side also. If let's say in terms of the inward side, your two suppliers are giving you same products under different HSN codes, and tomorrow let's say one of those suppliers is non-compliant, from the data which is coming to you, department may go back to them and basically ask a question to them. So that is why if you are short of your compliance of your outward side, in terms of better compliance perspective, it makes sense to replicate this exercise at your inward side of it, which is again obviously suggestive in nature. Then coming to the next aspect, that when you have entered the books of account, what happens is we are doing our accounting on the basis of the accounting standards, on the basis of Ind AS, and on the basis of the guidance note which ICAI has given to us. We may have AS7 in some cases. If that is applicable, we may have a percentage completion method, we may have a AS9, we may have Ind AS applicable as to how one would recognize the revenue, when a risk and reward would transfer, whether I would call that as my revenue activity or a cost reduction activity. Okay. Having said that, when I am looking at my books, or let's say when a revenue or a department is looking at my books, and specifically when I'm finalizing it, all of us are looking at the descriptions. I mean, so if let's say very simple generic one screenshot which I have taken from one books of account, it says sales account indirect income on the income side of it. Okay. Now let's say on my indirect income, on certain receipts I'm not paying GST, and I'm not paying GST on this understanding by saying that this is not a supply which I have made. Now when revenue would look at it, all of us would appreciate this, that revenue, at least those officers, they are not all coming from a commerce background where they understand what is accounting standard, what is the description, and all those things. They may understand GST quite well, but they may not understand the other aspect of it. So for them, what is there in the sales account and what is there in the indirect income, it will not make much of a difference to them. And for them, everything is an outward supply on which tax needs to be paid. Whereas what we are saying, I have some unbilled revenue, I have some unearned income, I have some exchange difference, I have certain provisions, all of that not taxable. I have in some cases some windfall gain, which is not a supply item. And that's where one important question which comes is, when you're finalizing a books of account, what happens to this discount, incentive, taxable, not taxable, how you should look at, whether you should think of changing your accounting practice, not think of changing the accounting practice. Now, I will not go into much of the details as to what is there in the law. I'm sure all of us are aware about it. All of us know that the pivotal point for levying any tax under GST under Section 9, that is a levy, is the supply, and the scope of supply is given in Section 7. It says there has to be an activity, it has to be for a consideration, it has to be in course and furtherance of business. Okay. And then we have a Bombay High Court judgment in case of by Mamubai Trust, which has in fact explained this concept quite beautifully, which judgment is not actually directly in relation to GST, but still there was an aspect of GST that was discussed there, and it says that GST is a subspecies of an enforceable contract. So that means whenever somebody has to levy GST on a certain transaction, that transaction in the eyes of Indian Contract Act 1872 has to be an enforceable contract where one person has agreed to supply goods or services and the other person has agreed to make a payment against that. What happens is when you look at the books of account, only that aspect of payment is visible. That is, I have received certain amounts. I have received amount against a supply of goods and service or not, that aspect is not visible. And that's where when we are finalizing, we have to keep into consideration as to what we are writing in our income, what we are writing, why are we writing it in income side, and is there a possibility that we can actually look into it, that disclosure can be made a little more elaborate if I'm not paying a tax GST on it, considering it is not a supply. So the factors that needs to be understood when you are determining that something would come in an income, but it will not be a supply, is to identify that when I'm looking at the income, I'm looking at the end result, that is the money which I'm receiving. Whereas supply, the starting point is most important, but the end result is secondary, that whether it is for an activity or a transaction. So it has to be an independent activity or a transaction. Second, in supply, consideration is not mandatory. So I may have consideration, I may not have consideration. All of us are aware about the deemed supplies. Whereas in income, if I do not have a real income, then the tax would not be levied, or at least I would not pay income tax in majority of the cases, and at least I will not recognize this as my revenue in the books of account. That means flow of money is mandatory. So two things which you understand from this top two is that for anything to call as revenue or income, flow of money is important. Whereas to call anything as a supply, flow of money is actually secondary. The activity is first. Okay. Income can be negative, obviously, but at least in terms of supply, my supply value cannot be negative. It has to be maximum. It can be anything. Minimum, it has to be zero. It can be beyond, cannot be below zero. Okay. And recovery of cost, and that's where actually the whole point comes in. That recovery of cost, it can be treated as an income, and I may put it as at my income side of it. Whereas recovery of cost, if I'm not able to identify a separate activity, it will not be a supply. Now, once I say this, it is important to understand that we have a judgment in respect of a New Zealand VAT, where they said that arrangement between the parties is not determined on the basis of what is the description which you're giving in your books of account or what is the description that the parties are giving to it, but it has to be on the basis of the conduct and the circumstances which are there. And when you read this, which says that the description of the transaction which you're giving is secondary, but the circumstances under which the transaction was entered, and second, what was the conduct of the parties in that particular transaction, that will actually supersede the description. And then you read two judgments of the Honorable Supreme Court in from the Indian Supreme Court, that is, tax would always follow what has been decided by the parties. Meaning thereby, if I have a clear agreement, where in agreement I have identified what is the activity which I have to, what is the supply I am doing, and then the money flow is flowing, then only tax would be leviable. When I read these two of them together, and then I go and read the circular which has been issued in respect of post-supply discounts or the incentives, I get a very clear picture as to what government is trying to say, and then how I reconcile that what I am writing in the income side of my books of account. So generally what happens is whatever you write in the income side of the books of account, we take a call by saying that I will pay tax on it. No matafuri, nothing I will not do. The problem starts arising when my recipient says I will not pay you GST because this is not a transaction leviable to GST. And then I see myself in a catch-22 situation where I want to write something as an income because of the accounting standards or because of whatever past practices I have been following. But the recipient is saying, no, this is not leviable to GST and I will not pay tax on it. That's where it becomes very important that on all those transactions which are coming in your income side and you're not discharging GST on it, you must have a written agreement or you must have a written understanding between both the parties as to why this amount which you are receiving, whether this is a post supply discount which you're receiving, whether this is an offshoot of an original transaction, whether you had already made an extra payment earlier and getting it back. All of that is important. Otherwise, department would definitely be influenced on the basis of the circular 105, which, like for example, in the majority of the cases you would have seen, it says if let's say I'm taking a special sales drive as a retailer, as a trader, as a distributor, as a sub distributor, if I am doing a sales drive for my OEM, then in that case, whatever reimbursement I'm getting for doing that sales drive, it's a supply which I'm doing for the OEM. Or let's say if let's say to augment my sale or to increase my sales, my OEM is saying you sell it 100 rupees and I will pay you 10 rupees extra. Then that 10 rupees is not a discount, but it is a 100 rupees given to me. 100 rupees I am getting from the customer and 10 rupees I am getting from the supplier. So these two things, when we see, if you do not have an agreement, when you do not have a written understanding, unfortunately, what you are writing on the income side of your books of account, that tends to give an impression that it is as good as the other supplies which have been done by you, and it is leviable to tax. So the sum and substance at the year end, look at your income side, whatever on which you're not paying tax, either find a clear exemption notification without any ambiguity. If exemption is not there and you want to take it out of the supply aspect only, you have to ensure that the return terms are absolutely clear, otherwise it creates a problem. The summary of it, this problem majorly arises when we receive a discount on our purchases and we call it a post supply discount or a volume discount and all those things. That's where the law tells you on the basis of the circular or the understanding which you get is, if it's a discount and it's a pre-agreed discount and the supplier is reducing its output tax, ensure that you reverse your ITC. If it is a pre-agreed discount or let's say not pre-agreed also, but a discount which is linked to your earlier purchases, then in that case ensure that I'm sorry, emergency service. Yeah, sorry. If it is a discount which may be a post supply discount, which may be pre-agreed, but on that case the supplier is not reducing the tax, no problem, you may still show it as your income, but you don't have to reverse your ITC. These are two aspects on which no GST is leviable on the person who is receiving this discount. In all other cases, that is the other two cases where some activity is identified which you are doing, either in an agent capacity or in a principal capacity as an independent person or maybe on behalf of somebody else, all of that is leviable to tax. So what you understand is, if it is a post supply discount showing in the income side and you do not have an agreement, where generally we say a circular came from the supplier, I had no idea, I was told by him that I have to follow this. Unfortunately, you are following into a case where without document you have not paid a tax and now you're not in a position to substantiate it. So year end is the right time where you go and push the OEM, tell the OEM that before taking a confirmation from me on the account that our account is settled for this year, give me a document by saying that whatever amount you have paid to me is on a post supply discount, post sale discount basis. Similarly, if let's say you as a supplier, you have given any post supply discount. So now we have a clear circular 212. So again, year end is the correct time where you go back, take this circular not for 23-24, not for 24-25 or the forthcoming years, but for the previous periods also, wherever you have issued a credit note for a discount, which is a post supply discount, take a confirmation from the recipient that he, she, or they have reversed the input tax credit. The circular tells you very clearly what should be the content of that particular certificate that the recipient has to give. If the value in a particular financial year from one recipient of the tax amount which they were supposed to reverse is more than 5 lakh rupees, then that certificate has to come from a third party independent chartered accountant or a cost accountant. So ensure that compliance is there. It is part of your books of account. So just not take an account confirmation or a balance confirmation from your recipient, but at the year end, take the certificate also. Otherwise, whatever tax which you are reducing by way of a credit note for a post-supply discount, department may tomorrow tell you that you are not entitled for it because you are not able to satisfy the condition that your recipient has reversed the input tax credit. And all those arguments where you tell it is appearing in the 2B of my recipient would have reversed in the 2B, it is a negative figure. Unfortunately, at the lower level, you would not be able to get a relief because now the circular is there which is binding on the department, and the departmental officer will not go beyond this. So if you want to still challenge this circular, you will have to go to the higher forum. But why do that? When we're talking about compliance, this compliance one should not miss, at least in terms of when you're talking about a post-sale discount. Coming to the unbilled revenue, now that is also a mystery at times, generally we overlook. That is, I'm saying at the year end, I'm making a provision, but I'm not making a billing in that respect. And then we all know that we have GSTR 9C when we do a reconciliation. So there are two specific tabs, table 5B and 5H. 5B tells me to include the unbilled revenue of the previous year, and it tells me to reduce the unbilled revenue of the current year to reach to my GST turnover. And sometimes a very strange argument is given by us to the department. When department would tell us, tell me at the point when you had made the billing for this unbilled revenue in the next year. We tell them, you look at 9C, in fact, the form itself tells me to reduce the unbilled revenue for the end of the year. So don't ask me what I have done to that particular unbilled revenue. But mind you, friends, the whole purpose of basically reducing and adding is where government is trying to tell you that you should have a reconciliation between your unbilled revenue and your time of supply provisions. So that's again at the year end, one should be aware of that there are two aspects that needs to be taken care of. Your accounting standard might tell you to follow the principle of conservatism. Your accounting concept may tell you to actually have a matching principle, but your accounting principles would not tell you that when you should do the billing in the next year. However, GST law is very clear that in case you're doing a continuous supply of goods or continuous supply of service, the time of supply is very clearly specified. If the due date is there in the agreement, the date of agreement, if the due date is not there, then event is identified. Then what is that event which is identified in the agreement? And if that is also not there, then when the payment is actually received, at that point of time, you have raised the invoice. Okay. Generally, we don't see a situation where the due date is mentioned in the agreement. So we will skip that part. If that is there in the agreement, it is quite clear where I was supposed to do the billing. The tricky part is where generally all the agreements, specifically in case of a service, long-term service contracts, works contract, construction contracts, all those contracts which are ranging beyond 3 months, all those are event-based. They are based on an activity, they're based on a milestone. So my contract period is maybe more than 3 months, but I have to do certain activities to reach to a particular milestone. And if I've done that activity, then the contract will tell me that now I can raise the invoice. My accounting standard would tell me to follow the matching principle. So if I've already incurred the cost, but my milestone has not come, then I will book an unbilled revenue in my books of account. So that's how I will match my books of account from a matching principle basis. Now, when will I do the billing? For that, the tracker has to be there that when was the event or the milestone achieved. And for that, we have a service tax circular in 2011. It may have a persuasive value in GST. It says when you're looking at an activity or an event, ensure to it that you're able to substantiate that the supplier has delivered and all the ancillary activities around it, which are mandatory to prove that the activity is complete, are also done. And those ancillary activities should be measurable. So for me, for example, if let's say I am doing a continuous audit for a client for let's say 3 months, and if I have submitted my audit report, and let's say I have booked an unbilled provision in my revenue side of it, then tomorrow GST officer may ask me, tell me at what point of time you have booked this unbilled revenue or converted it into a tax invoice. And there I will have to corroborate my agreement. Along with that, at date on which my audit report was confirmed by the client, because I am assuming that would be the day when I can say that yes, my audit was completed when the client had confirmed to me that yes, your audit report is accepted, approved, taken on record, and whatever it is. So if I'm not able to do that when I'm booking a provision, then I have to see to it what is the timeline which I'm seeking at, what I'm looking at, and ensure I keep a record of it. Otherwise, it becomes a timing lapse issue and it would attract unnecessary scrutiny from the department side. Opposite of that is mobilization advance again, which may not form part of your revenue, but you may show it in your liability side where you have received an amount from your customer and the customer has told you that it is a mobilization advance for you, again generally for big turnkey projects, for big works contract activities, and the recipient has told you that you use this amount and you basically adjust this amount against the progressive billing which you're going to do over the period of time. Now we know that in GST, in respect of services which we give on advances, I am supposed to pay the GST. The problem is that this mobilization advance, which is generally received, it is not understood as an advance, or even if it is understood as an advance, the amount is received and it is immediately paid to the third party supplier so that I am able to actually mobilize the goods for provision of that long term turnkey project. Now the question which comes is whether the GST has to be paid or not. And if I have not paid and I'm still showing it as a mobilization advance in my books of account, what will happen? So at the time of finalization, I have to understand and see to it whether this mobilization advance is actually an advance or a deposit. And that's the crucial difference of that would come from the, the nomenclature which I am going to give in my books of account, the manner in which I am going to disclose this amount in my books of account, and again the manner in which I am going to deduct it further or adjust this further against the subsequent billing which I am going to do. So we have a 2020 service tax regime judgment of Gammon India, which has said that see, if I am receiving something as an amount which is treated as a mobilization advance, but it is interest bearing in nature, or it is in a nature that it gives an understanding that it is more of a deposit or a short-term financing accommodation which was done against the billing which was to be done in future, then it is not a mobilization advance, but it is just a financing activity which has taken place from the recipient to the supplier. Now, while saying so in Gammon India, the tribunal was able to appreciate that the contract terms were very clear. There was an interest portion that was required to be paid. And it was also very clear that the though term mobilization advance was used, but it was in the nature of deposit that it had to be repaid back. So this was not something that an advance which I can adjust, but it had to be repaid back. But the repayment had happened by way of adjusting it against the amount which I have to receive from the invoice. Now, when I am seeing all of this, what happens is when we are finalizing our books of account and we're looking at it from a perspective whether this is an advance or a deposit, a disclosure in this regard would be very efficient and very useful as a footnote, as a part of your notes to accounts, where you explain that whatever has been mentioned in your current liabilities or maybe somewhere in the liabilities, it may have a terminology as a mobilization advance, but it is not adjustable, but it is repayable against the billing that needs to be done. Now, the consequences of it definitely. What are the consequences under Companies Act? Whether can I do that? Do I have to give a separate disclosure of it? Whether it may fall under a loan category or not? Whether I have to make a disclosure under 3CD or not? All of that will be definitely ancillary questions that needs to be answered by the person who is taking the responsibility of finalizing the books of account. But if that is being taken care of, then in that case, if somebody who is not paying a tax on the mobilization advance would be able to substantiate that this was not an advance, but it was a deposit, which does not fall in the category of consideration which is defined under 2 subsection 31 of the CGST Act. So that is one aspect that needs to be taken care of. Then we come to accounts and records. Now, we are any which way maintaining records on a regular basis. We are giving a respective disclosure of it in respective acts. In GST also, we know we have section 35, which talks about having records and accounts under which needs to be maintained. But there are 2-3 things that an assessee should take care of. And when I say this specifically at the year end, to identify what they have done in the whole year. One is that on a monthly basis, you are giving some information to the government. And that information is in table 13 of your GSTR1, where table 13 of the GSTR1 tells you that you have to give the document series to the government. Okay. And document series of various types of documents which you have issued in that particular month for which you're filing your GSTR1. When you would look at it, you'll see it talks about tax invoice, reverse charge invoice, credit note, debit note, and all those things. So this is the first time when you're exposing your account records to the government on a monthly basis. You may be proper in doing so. If you're doing that, that is fantastic. If you're not doing it properly here, that's where at the time of the at the end of the year, your role comes in, where maybe at the monthly recording or monthly reporting, it may not be feasible due to time constraints or otherwise. Where you look at books of accounts, section 35, and you see to it that it tells you 5 important things which any person has to maintain. Okay. Now the terminology which is given is production, inward, outward, stock, input tax, credit avail, and output tax. When you would translate that into accounting language, that what are they really talking about? Basically, they are saying that you should have monthly production records. So even if you are, let's say, giving a disclosure anywhere in income tax or otherwise, you do not have a production record. Unfortunately, in GST, there is no exemption for you if you are a manufacturer, be it a small manufacturer or a big manufacturer. You need to have a production record on a monthly basis. It says inward and outward register. And sometimes we say inward register is nothing but my purchase register. Well, the answer is yes, it is your purchase register, but it is just not your purchase register. It is purchase register along with your journal. In that journal register, wherever tax implication is there. So in journal, we do a lot of accounting entries, but wherever tax implication is there, you make it part of your purchase register, and then together it is called as your inward register. Similarly, your outward register is not only your sales register. Your sales register along with other income which you are passing through your journal and not passing through your sales register, together that is called as your outward register. Stock of goods is your monthly stock statements. Input tax credit avail. Now that's where it is your ITC register as per your books of account matched with your ITC ledger. When I say this again, sometimes we say ITC register means tax which I'm showing in my purchase register. And again, the answer to that is unfortunately no. It is your purchase register tax plus whatever GST credits are passing through your journal register put together in a specific format is your ITC register. And if you're able to match it, a total credit taken from your ITC ledger, then that you can say it is a record of your ITC credit availed. Similarly, your output tax payable, it's a sales register, journal register, whatever tax details are there in it, match with your tax payable is called as your output tax payable. So these details are mandatory details. Okay, one question which has been asked by Ranveer Ji is it mandatory to disclose document issued during the month in GSTR1? The answer is yes. There is no exemption available. There is nowhere mentioned that you're not supposed to punch details of table 13. So if you are not writing it, actually we are non-compliant with it. Now, what is the impact of the non-compliance is again over the period of time somebody would see. But yes, we can mitigate that impact if we are able to have these records on a yearly basis available with us. So what will happen? You will not report. Department tomorrow will take a cognizance of it. They might ask a question by saying, why are you not doing it? And the answer to that would be, that is a procedural lapse which has happened, but I maintained proper records which were required to be maintained as per section 35. Okay. Whether HSN data given in GST1 has to be accurate? Again, the answer is yes. There is absolutely no denying fact to it. In fact, you would have seen a lot of notices on the basis of whatever HSN data which you have punched in your GSTR1 and HSN data which you have punched in your GSTR9. Department has picked that, identified the gap of it, and issued a show cause notice. Again, that show cause notice is a bogus show cause notice. But which I'm trying to emphasize here is, if it is a notice which is on a law point, you would enjoy answering that. In fact, the client would also appreciate that notice. If a notice is based on the data which you have punched in your returns and which is there in your books of account, neither you will enjoy that nor your client will enjoy giving information giving you in that regard. And that's where all these notices becomes very tricky, because they are all information based show cause notices there, because the information was not proper at the time of punching. It would not be possible to say that after 2 years, 3 years, I will have proper information available. So that is why it makes a lot of sense that when you're finalizing a books of account, you're doing all these types of reconciliations. Okay. So yes, these are 5 types of basically records which you're supposed to have on a yearly basis. Okay. Now, when you look at the stock record, there are section 35 read with rule 56. In terms of production register, it tells you one more unique thing. And sometimes we miss that. It says quantitative detail of raw material or services used in manufacture of goods and quantitative detail of goods and services which are used in provision of a service. And effectively, it is not saying that whatever you have purchased, give me a detail of it. That is your ITC register. It says whatever you have purchased and you're telling me that you have used that for the purpose of manufacture, tell me what is your consumption pattern. Now tell you effectively what government is telling you. Today we are not tracking it. But tomorrow your 3CD where you write material consumed to finished goods produced ratio, whatever values you're writing there, if tomorrow we might tell you to reconcile it on the basis of what you're writing in your GST record, because GST records specifically tell you to basically give this detail of consumption, it should match. And if it is not matching and your ITC claim is disproportionate there, then definitely a question would come. You might have purchased goods and services in course and furtherance of your business, but your record keeping is not proper. Because record keeping is not proper, we have section 35(6). And 35(6) says if your record keeping is not proper, then the officer may proceed on the basis of his best judgment assessment and may issue a show cause notice under 73 and 74. So that becomes a problem. In a sense to say, you might always give an argument by saying whatever I have purchased, give me credit on the basis of section 16(1). It is in course and furtherance of my business. I intended to use it, which is absolutely right. But because your record keeping is not proper, you can't stop the officer from not giving a notice to you under 35(6). So at the year end, it is very important that if you are overlooking our stock record, if you are overlooking our consumption pattern, if you are not able to give a details as to how my consumption in respect of goods and services has taken place, then it kind of creates a red flag. It kind of create a situation for me which may not be very comfortable for me to answer if a question is asked regarding this to me. Okay, so that is one aspect that needs to be taken care of. I would not go into detail that we have to maintain a job work register, delivery challan register. I'm sure all of us are aware about it. We can't overlook that. All of us know it. When a compliance has to be done in that regard, we need to maintain a record. But only that specific point in respect of production register, I wanted to emphasize upon. Then the next point which comes in, and generally that has been a bigger issue in last 2-3 years, all those assessees which have a multi-state presence, there the question comes that whether they have to give a trial balance of that particular GSTN where they have not maintained the trial balance at a GSTN level. And this problems become even more peculiar in all those cases where tally is not there. They have another ERP, be it SAP, Oracle, or Windows, which has not been customized by the assessee in a manner to say that I am able to bring out trial balance at a GSTN level. Okay. Okay, one question has been asked by Sandeep ji that do we have to separately show normal loss and abnormal loss? The answer is yes, absolutely yes. You have to show that. Why? Because in terms of a normal loss, we have a judgment from Madras High Court in case of ARS Steel, which says that ITC reversal is not required. But in terms of abnormal loss, the situation may arise that department would like to enforce section 17(5)(h). Now, whether 17(5)(h), which is goods lost, stolen, destroyed, written off by way of gift or free sample, whether it will fall in that or not fall in that, it's a separate issue. I'm not on that issue whether it will be proper or not. But again, department would be correct in their understanding to raise a show cause notice only in respect of the abnormalness. Now, wherever again in a specific year, wherever you will have an abnormal loss, that pattern will change comprehensively. Wherein sense in 2-3 years you might have a specific loss which is there, but in 1 year you might have a loss figure which will be higher. So it always makes sense to show it separately. You would actually abnormal loss, you would record that in your books of accounts separately also. Any which way when you will do that, you will have to take a call whether you want to reverse the credit or not. Okay. So I was the trial balance point, that whether trial balance has to be given state-wise or not. Well, again, the answer to that, rather than giving an answer on a generic basis, the answer to that is there in section 71. Section 71 says that departmental officer is able to access your business premise once you have an authorization, and that authorization can be for scrutiny, for audit, or for summon, or for the survey purposes. And once that happens, section 71 says that these three records plus any other record which he finds relevant, he may ask for it. And you see trial balance is clearly mentioned there, cost audit report is mentioned there, and statement of annual financial account is mentioned there. That means one can't take an argument by saying that I should not, or I'm not required by law under Income Tax or Companies Act to maintain a GST and vice trial balance. In my understanding, you are required to maintain, or you are mandated by law under section 71 to make available trial balance to the proper officer if he asks for it. And obviously you will be able to make him available only when you prepare that. So your end is the correct time where you actually look at your books of account on the basis of a cost center and profit centers, identify your revenues and expenses of a particular GSTN. Either system should be able to give you a trial balance separately. If system is not able to give you separately, you may have to draw it on the basis of a cost center and profit centers which are there. Okay. Then I come to document series. Next thing at the year end that needs to be taken care of, that what do I need to do? Do I have to have a document series for a particular financial year? You see 24-25 is 23-24 and 25-26 is 24-25. So again, year end for whatever has happened in the earlier year, it is a good time to actually look at it and see to it whether there has been any duplicacy. Though if you are into e-invoicing, there will be a very minimum possibility that you would have done any duplicacy, but you might have generated a new series altogether. And generally that happens when you miss a particular invoice in between. One of those exceptional situations where specifically in exports, where you prepared the invoice but the goods have reached to the port, shipping bill is not generated, you have generated an e-invoice and now shipping bill has to be regenerated fresh, and there the custom authorities tells you to give you a fresh invoice. There a stopgap arrangement which is being done is a new invoice. Let's say 167 was my invoice number, I'll generate a new invoice 167A, and suddenly in the year I will only have one invoice which will be 167A and no other invoice. What should be done? Well, at least the advice would be in terms of compliance, because you have done that, and law does not stops you from having a multiple series in a particular financial year. If you have reported that in table 13, don't do anything. You have already made a disclosure to the government. If you have not reported that in table 13, then it always makes sense to write a letter to your jurisdictional assistant commissioner and send it by post, and write at the year end that these were the document series which I have generated in the year. I have missed reporting that in table 13 of my GSTR1, and for the better compliance purposes, I am writing a letter to you. You're not supposed to visit to the department, not supposed to explain this to anybody, but just for the sake of compliance, write a letter to the department. That will be very helpful for you. All those cases where suddenly, again, on the basis of data mining, tomorrow you get a notice by saying that you only have one invoice which has an exceptional series, or not series, rather one invoice which is not in the proper series, and we do not treat it as proper. So that is one thing that needs to be taken care of. See to it that you have delivery challan series duly maintained, because delivery challan does not have an IRN, it does not have a QR code, it does not have an e-invoicing details. So one might have a delivery challan prepared by various people, and because delivery challan is a non-accounting document, so in that case, it becomes very important at the year end you compile all the delivery challans, see to it that they have been properly reported. If they have not been reported, at least you have a series of it duly prepared. And again, if you think something exceptional has happened, just send a letter to the department so that it becomes a proper compliance there. For the next year, is it mandatory to start from 1? The answer is absolutely no. If you want to continue from the next number, which was there, the number of your last invoice of a previous year, you may absolutely do so. If you want to start a new series, you may definitely do that. But ensure to it that you report that in your GSTR1 in table 13, and you don't miss that. In fact, not only report your tax invoices, but report your credit note, debit note, RCM invoices, and delivery challans also, because that's what law requires us to do. Next, coming to credit note, debit note, and this is one area where only at the year end you will be able to identify that if there has been some mismatches which has happened or not. So what happens is in GST, all credit notes and debit notes which are to be reported on GST portal, they are governed by the action of supplier. As a recipient, even if I'm issuing any credit note or debit note, that is only for the accounting purposes. It is they are not reported on the GST portal. Now, sometimes what happens is if let's say a supplier has issued a credit note to me, okay, in terms of certain purchases which I have done, and I want to give it back to the supplier. Now, supplier has issued a credit note to me, but that credit note somehow has been missed by my accounts team. Or let's say I have a system that when I am returning back to the supplier, I am issuing my invoice to the supplier. So it creates a situation where supplier has reported a credit note in his GSTR1 reflecting in my GSTR2B. And I have also issued an invoice to the supplier for return of goods and it is also reflecting in his GSTR2B. Now, both the items will remain as a mismatch because both the entities, supplier and receiver, they will rely on their own document rather than relying on the document which is issued by the other person. And that's why at the year end, it makes sense to take a note of all these credit notes and return invoices which has been issued by the supplier and recipient respectively, and see to it that both of you reach to an amicable situation where one person is ready to withdraw the document by cancelling it or by issuing a counter document to it, and that is done before the time limit where the rectification can be done. Because if same is not done, now, because the credits are governed by GSTR 2B, it will create a problem where I have a credit note issued by the supplier. So I have to compulsorily reduce my credit. And at the same time, I've issued an invoice where I have paid an output tax. So it will lead to a situation where I'm being double taxed to the government, which was definitely not agreed or that was not expected out of the transaction. And that's where at the year end a comprehensive exercise of all the credit note issued by the supplier and one-to-one reporting of it has to be done at the year. So that one exercise that really needs to be taken care of. Second exercise in terms of credit note that needs to be done is we have seen the circular just now which we had referred in terms of post sale discount. But we know in GST you can issue credit note not only for post sale discount but also in terms wherever there is any deficiency, whenever there is any return of goods, or let's say wherever there was an error in the invoice. So let's say as a supplier, I've issued a credit note not for the purpose of discount but for other purposes. Now, Section 34 tells me that if I am issuing a credit note, I have to prove that I have not passed on the incidence of tax. Mind you, Section 15(3)(b) tells me that I have to prove that if I am issuing a credit note for a post-supply discount, my receiver should have reversed the credit. Section 34 tells me whatever credit notes I've issued, I have to prove that the burden of tax has not been passed on to the receiver. Meaning thereby, in wherever I'm giving a credit note for a discount, I have to prove two things. That that receiver has reversed the credit, and also that the burden of tax has not been passed on to it. For all other credit notes, I have to prove that burden of tax has not been passed on to him. Meaning thereby, I should have a copy of ledger account in his books of account of mine, where an entry of my credit note has been done by him, and my payable account in his books of account has been reduced to that extent. Actually, that is the proper compliance of not passing of incidence of tax to the recipient. One may say that it is too far-fetched, but that's how the law is written. Law talks about two separate compliances that needs to be taken care of. And again, as a part of an year-end activity, one should actually make a note of it and take that declaration. One question which has come from Shubham is, do we have to report credit note and debit note and export on goods where IGST is being charged? Yes, absolutely, Shubham. Those credit notes have to be reported in terms of export of goods or services. In fact, if your export of goods and services has been under LUT also and no tax has been charged because of the LUT, then in those cases also you are supposed to report your debit notes and credit notes in your GSTR1. In fact, now we have a mechanism also where if you have, let's say, if you have issued a debit note in terms of an invoice where you've already paid the tax and then you're paying additional tax due to upward revision of price, then in that case, there is a mechanism to claim the refund also. But that can only be done when you report that in your GSTR1. So yes, reporting has to be done. In terms of credit note, one more additional compliance that needs to be checked at the year end is that except for discount, wherever I am receiving my goods back, I should have a proper GRN, proper e-way bill for receipt of rejected goods. And that is very important for me to prove that whatever sales return has happened, that sales return has been returned back to me. Otherwise, tomorrow department can ask a question that if I've done a sales return, then where those goods have gone. And if I'm not able to prove that again, that raises a red flag. And in that case, department may ask me to again reverse my credit note. So that's an important exercise that needs to be done and taken care of. Okay. Then we come to reverse charge compliances. Now, in terms of reverse charge, we know there are two separate types of compliances that needs to be done. And again, when you're finalizing your books, you have to bifurcate the suppliers on whose supplies, which were inward supplies for you, on which you have paid tax and a reverse charge, whether they were registered or unregistered. If the supplier was registered, then in that case, you have to ensure that his invoice is proper, that his invoice has an endorsement and what is the amount of tax which I have to pay under reverse charge. That supplier has filed GSTR1 and that credit is appearing in my GSTR2B. So if I am not doing that exercise at the year end and I'm missing the deadline of 30th November, then in that case, it will become a situation where I will have to pay tax under reverse charge, but I will not be able to claim the credit. Vis-a-vis, you come to a situation where supplier is unregistered, but I still have to pay tax under reverse charge. There we have a recent circular which says that you can claim the credit on the basis of the self invoice which you prepare, and that self invoice you can prepare on the date on which you're making the payment. Up till now, there is no time limit which is there as to when that self invoice needs to be prepared in certain cases. Otherwise, the time of supply provisions in 13.3 are very clear. But in certain cases, in terms of reverse charge, the time limit is not clear. There now in this Finance Act 2024, that has been also taken care of, but it is not applicable yet. So at least for financial year 23-24, which we are closing, in those cases of all the previous years, wherever I have not paid tax under reverse charge, if I missed paying tax under reverse charge in that particular year, and I'm receiving an invoice from an unregistered supplier, then in that case, I can pay tax under reverse charge, I can claim the credit, and I can issue a self invoice. But I cannot issue a self invoice where my supplier is registered. In fact, I have to ensure that his credit is appearing in my 2B with a tick mark that tax is payable under reverse charge, yes, then only I'll be able to claim the credit. Wherever I'm making foreign payments and wherever Form 15CA and 15CB has been issued in terms of income tax compliances for Section 195, I should go back and check whether on those I have to pay tax on import of services. I have to check whether the place of supply in those are outside India or not. If, let's say, in majority of the cases, what happens is an exporter makes a payment for export commission outside India. So if that payment has been made for export commission outside India, then no reverse charge. But otherwise, in generic cases, this can be a good base document because bank will not make the payment without having this 15 CA. So taking 15 CA, reconciling it as to out of this, how much I paid on those transactions which I paid tax, all those transactions on which I have not paid tax, what is the reason for that? And if I'm able to substantiate the reason, then it's a proper RCM compliance at the year end, which I'm taking care of. One more compliance which generally gets missed, where department is able to find that out because they put that in their SOP is payment to government. So we know that payment to government is under reverse charge. There are certain exemptions which are available in notification 12/17, where if let's say payment in a particular transaction is less than 5,000 rupees, or if this payment is for a registration under a specific law, or this payment is for getting a fire license, or it is in respect of protection of safety of worker and public at large, then exemption is available. So I have to test all the payments which I am making to the government, except for the payment of taxes, which are any which way outside the levy of GST. All other payments of fees which I'm making to the government, I need to check whether I qualify for the exemption in all these cases. If I do not qualify for exemption, then in all those cases, I have to pay tax and a reverse charge and claim a credit of it by issuing a self invoice. Mind you, friends, if you're able to do so even in the extended time limit, that is up till 30th of November from the end of the year, there will not be any question on the credit. But if you do it afterwards, then definitely department is raising questions. Well, in at least in case of unregistered cases, now that problem would be solved. But now we have a now we have new amendment coming in section 13.3. And according to me, that will now put a time limit in all those cases where you have to pay tax in the reverse charge where supplier is unregistered. So it is an important compliance that you should not miss. Okay. One question which has been raised is payment to government for licenses which are being reimbursed by the client, RCM should be charged or not. There one can take a view by saying that I am a pure agent, and in that case I can claim benefit of section 33. So if let's say I'm making a payment for a license on behalf of a client and I'm charging exactly the same amount for which the license has been paid to the government, and the license is issued in name of the client, not in my name, and I'm charging a separate fee, or let's say I'm charging, not charging, that's a separate issue, but I'm not charging my fee and whatever payment I made on lump sum basis, then I can claim benefit of section 33 by saying that I'm a pure agent. I can take it out of the transaction value and I need not pay tax under reverse charge. But in all other cases, I will definitely be required to pay tax under reverse charge. Okay. Foreign payments, I think we've already discussed, so we will not go into that detail. Next, one very small procedural compliance, but that needs to be taken care of is updating registration certificate. Now, one would say generally we do that whenever there is a change in name of partner, whenever there is change in name of address, but sometimes you miss out one activity. That is when you took your registration, you gave list of your top 5 goods or top 5 services which you are supplying. Okay. So at the time of your registration, you had your top 5 HSN codes. Now, over the period of time, what happens is our nature of business, our composition of HSN code changes. Sometimes one HSN code is on a higher amount, on a lower amount. Sometimes new HSN codes come in. Now in GST, it is unlike VAT or service tax where you have to add your services or goods first to actually do that activity. But there is a clear provision under Rule 19 which says that whatever details are there in your registration certificate, if they undergo a change, then you have to get yourself that you have to get it as amended within 15 days. So if your top 5 HSN codes are changing, you have to get it changed. It may not be possible during the year that you do that. So maybe at the end of the year when you have a HSN summary of whatever supplies you have made, and if in that case your top 5 does not match with the top with the 5 HSN codes which are mentioned in your registration certificate, you should get a registration certificate updated, add the new HSN codes which form the majority part of your business now, so that you save yourself from a general penalty. Because I have seen notices issued by the department where they are looking at this compliance and they're saying this is a procedural non-compliance which you have done, for which we are going to levy a general penalty. Again, whether that will sustain, not sustain is a separate issue. But yes, a notice in this regard can definitely be issued by the government. Then we come to ITC related tasks. Now in ITC related tasks, all of us know we have section 16.2 where there are 6 compliances are there. 6 compliances say that I should have an invoice, I should receive goods and services, I should see to it that it appears in my 2B, it is not restricted, and I file my GSTR 3B also. Okay. And I see to it that my supplier has also paid the tax. If I'm taking care of all of this, then in that case, I'm able to actually say that my compliance is proper. Year end, when you're finalizing books of account, always make it a point that it becomes very important that now not your compliance is important, but what is the conduct of a supplier, which is also very important. And these days, the type of fake invoices which we see, where you do not have a control as to from where your supplier has bought goods and services, but those goods and services are coming at your doorstep along with an invoice, and all the highlighted portions you are complying with, and yet you receive a notice from the government department by saying that your purchases are invalid and improper. That's where you should see to it that the first 2 tabs which are there, that is purchase order or a contract, and second invoice along with LR copy and e-way bill, you should always have it. So invoice copy you will definitely have, but LR copy and e-way bill along with the purchase order will definitely be able to help you to prove that you had placed a genuine order on the supplier supplier has actually made supplies against that particular transaction. It may not be conclusive, but it will definitely be persuasive in nature. It will strengthen your claim of credit under section 155. So my purpose of saying this is, every time you may not have a purchase order or a contract, but on a yearly basis, let's say when you're closing your books of account, when you're looking at your large supplies from a big supplier, maybe at the year end of it, you may write a comfort letter where you tell the supplier that I've purchased these goods and services from you. I just want a confirmation from you, and they endorse that in document and give it back to you. That will definitely help and serve you. Specifically, if you deal in a tricky industry, an industry which is vulnerable to fake invoicing, this document will definitely be able to help you in compliance. Okay. One question from Mr. Deepak. He is asking, sir, whether for reverse charge, self-invoicing separate series can be made, especially when client has not made self-invoice and now needs to comply. The answer is absolutely yes. In respect of series, there is absolutely no restriction in the law. So if you want to have a series on a daily basis also, you can do so. Subject to that you are able to substantiate your daily series was sequential in number and it included all the invoices of that particular day. So yes, you can do so if you're making a invoice today and then you want to have a separate series altogether for each supplier, you can do so, but it has to be chronological in order. That is one aspect that you need to keep in mind. So in terms of ITC year end, as a post facto audit, when you're doing of your ITC, just not look at the invoice and the portal compliances, but the two other qualitative aspects of what is the pattern of basically receiving the goods and services and how you can substantiate it. These two factors are very important. Okay. Then we go to one important change which has happened this year in 23-24 is the manner in which you file your GSTR 3B. And it has been a big change in terms of where a lot of people have unfortunately followed different and divergent practices because the changes happened during the year also. So people have followed the approach, people have not followed the approach, and people were forced to follow what government wanted on the basis of DRC 1C notices which were issued. So you know that we have been issued DRC 1B and DRC 1C by the department. DRC 1B when there is a mismatch in your GSTR 1 and 3B, and DRC 1C when there is a mismatch between your GSTR 2B and the credit which is coming in your GSTR 3B. Government has told us that now the starting point of your GSTR 3B has to be the credit appearing in your 2B. And from that, you may do addition and subtraction. But mind you, the addition cannot be more than what you have not claimed in the previous period. So it is very simple. Put your GSTR 2B figure. What you don't want to claim right now, reverse it. You can reverse on a temporary or a permanent basis. Whatever you reverse on a temporary basis becomes part of your reclaim statement. And next time when you want to claim the credit or reclaim that credit, you should ensure that your reclaim statement should have a positive number. Maybe during the course of filing monthly returns, this becomes a tedious exercise. Sometimes in majority of the cases, what I have seen, that the reclaim statement has shown a negative figure and we're not able to understand how can my reclaim credit can be negative. The credit which I have to reclaim, it cannot be negative. And that's because some of us have faltered in putting the correct opening balances in the reclaim statement, which government wanted us to do so. That was in financial year 22-23. And because of that, that negative figure is continuing up till now. Now, the focus of department is all on those DRCs 1C. You might have seen that there was a DRC 1C issued to you. You might have replied to it and subsequently no notice is issued to you. You're also wondering that why on the basis of my simple reply has department agreed to it. Well, now those notices have started coming in. That where on the basis of that DRC 1C, they are converting into those show cause notices because they had time to issue the show cause notices. So year end is the correct time where you actually redraw your GSTR 3B. All of us know that you get your GSTR 3B on a yearly basis on a single click of a button when you go to annual return tab. So if you go to annual return tab, you can have one GSTR 3B for the whole year. That is system generated based on how have you filed your 12 GSTR 3B. Okay. Now, year end should be an exercise where you recompute and re-prepare your GSTR 3B basis your annual to be reconciliation, basis your annual purchase register, basis your annual ITC register, and you see to it that if you were filing a GSTR 3B for the whole year, how it would have looked. Whatever difference comes in is actually becomes a point for you to scrutinize, and on the basis of it, you should be able to take a corrective step in the next subsequent GSTR 3B. This exercise is important because your reclaim statement which you have done, those reclaim statements are important because this year, as I was saying, 23-24, you can bifurcate into two parts: prior to July 23 and post July 23. Prior to July 23, we did not have this situation where we had to start our 3B on the basis of what is the figure appearing in 2A. Post July 23, government is forcing us to start our GSTR 3B with our GSTR 2B figure. Even if it relates to you, does not relate to you. That starting point has to be there. So year end 23-24 bifurcate in two part: pre July 23, post July 23. See to it how you have done the compliance. Identify the reason for negative your electronic reclaim statement figure, and if you're not able to correct it on the portal, write a letter to your jurisdictional assistant commissioner and mention with the facts, so that tomorrow when you get a notice, you should be able to demonstrate that you've already done the working and given it to the government. Otherwise, tomorrow it may become a new headache and a new nightmare for you, like the 2A 3B mismatches for the earlier years. We have to do one more compliance from this year in 23-24, where we don't have to only do a matching of credit which is there in our GSTR 2B. We have to also do a matching of the credit which is appearing in GSTR 2A. Why? Because we have new rule 37A, which tells us that in respect of that, the supplier should have paid the tax. Now, GSTR 2B does not tell us whether supplier has paid the tax or not, but our GSTR 2A tells us whether supplier has paid the tax or not. So whatever credit you have claimed in your GSTR 3B, on an annual basis, you have to recompare that with GSTR 2A. The deadline is up till September 2024, you may do that. And whatever credits in which in GSTR 2A, the supplier 3B filing status is no. You have to reverse the credit up till 30th of November 2024. And if you don't do that, then you will be required to pay the interest also. Once the supplier pays or files his GSTR 3B, you will be able to reavail the credit. So Rule 37A compliance this year has to be done. Maybe you have time up till September where you can wait, but it makes a lot of sense to actually compare with GSTR 2A, which is coming on the current date, so that you are able to identify those suppliers who might have filed GSTR 1 but not filed GSTR 3B, communicate with them, tell them to file GSTR 3B, or at least get the status of GSTR 3B filing rectified in your GSTR 2A, so that your credit claim, you don't have to reverse that in the subsequent months. So this is one exercise in terms of ITC that needs to be done at the year end. There is another activity, at least two, which are important at the year end that you could do. 180-day compliance. The heading title which you see of procedural difficulty, which I mentioned. Now, after October 2023, you cannot take an argument that 180-day compliance I cannot do because the rule was not supporting me. Government has made all the efforts, at least from 23-24, that nobody comes up to them and tells them that GSTR 3B is not the form to reverse the credit, the section is not aligned with the law. All those things they are taken care of. They have made amendment in the law. So 23-24 is that 1 year now. If you don't reverse the credit within, if you have not paid the payment within 180 days and don't reverse it, you will have to pay tax and you will be required to pay the applicable interest also. So at least by now, all of us have become aware as to how it needs to be done. This year is no exception. In fact, I will say this year is that first year where we have necessary law support which tells us that reversal needs to be done. Exempt supplies reversal, I'll come in a while. Third, which is important, is deciding depreciation. Income tax depreciation vis-a-vis input tax credit. If I have claimed an income tax depreciation on a GST portion, I cannot claim the credit. So I have to see to it that when I'm deciding what is the amount of value of the asset which will go in my block under income tax, I have to see to it that it does not have a GST portion. If it has a GST portion, then I am not claiming an input tax credit of it. Mind you, the depreciation which is relevant for the purpose of this is the income tax depreciation. No doubt, for the matter of consistency, we will write our Companies Act depreciation like this also. But at least from a law perspective, your income tax depreciation should not have a GST portion. If it has it, then you will not be able to claim the credit under GST. Year end, again, you have to bifurcate your input tax credit into three baskets: capital goods, inputs, and input services. Why? Because in certain cases, the compliance mechanism gets completely changed, specifically if you have to do any ITC reversal related to exempt supplies. Specifically, if you have to sell any inputs or capital goods, then the mechanism for payment of taxes changes comprehensively. Okay, so that bifurcation is required. Again, at the time of booking it, generally the ERPs does not support this facility. In fact, majority ERPs, we do not write HSN codes also at the time of punching the input tax credit, because we don't do that. Hence, that is why at the year end, it makes sense that when you're drawing our ITC register, we are putting this bifurcation. Why am I telling you this is that this is relevant, that in terms of immovable property, ITC is blocked. We can't claim the credit. Okay. Now, immovable property, there are lots of ifs and buts that this credit is allowed, is not allowed. For example, I'm capitalizing purchase of goods and services into a building in my books of account. Credit not allowed. But then there is an exception. Exception is credit of plant and machinery, even if it is immovable property, the credit is allowed. So the question comes, if let's say I have purchased a lift and I've got it installed into a building and the lift is capitalized in the building, then can I claim the credit? Well, theoretically speaking, yes, you can claim it, because lift is plant and machinery in spite of the fact that it is immovable in nature. Then the next question comes is, if let's say even if it is plant and machinery, do I have to prove any other thing to claim the credit? The answer is yes. You have to prove one more thing. It is used for provision of your outward supplies of either goods or services. So that means again a differentiation comes. Can I claim credit of a passenger lift, or can I claim credit of a goods lift in a factory? So maybe in a factory, credit of a goods lift is very easy to prove that it has a nexus of my output supply. But credit of a passenger lift with my output supply, very disputed. You have to take a call whether you want to go into that dispute or not. Okay. Then third question, credit of repair of building, allowed, not allowed? Definitely allowed, subject to the fact that accounting is proper as per the accounting standard. That means if it is part of the repair, accounting standards do allow me to make it part of the repair of building. That means I was not supposed to capitalize it. Fourth, I'm putting something as part of my building, but it is foundation of plant and machinery. Can I claim credit? The answer is yes, you can do so, even if it is part of a building. But if whether it is foundation of plant and machinery, you can't decide, I can't decide, officer can't decide. That a chartered engineer only can decide, because he is the competent person to say whether this plant and machinery requires foundation or not. Fourth, depreciation has been claimed, definitely credit not allowed. Fifth, leasehold rights, which are there part of my books of account, where I paid heavy tax in buying those leasehold rights, can I claim the credit? Answer is yes, you can claim that. Department as of now is litigating it. Whether you want to go into that litigation or want to enjoy the depreciation, that's the decision you have to make at the year end. Mind you, if you lose, don't claim the depreciation today, to claim the credit. And tomorrow you decide to forego the credit and make it part of your blog and you want to claim depreciation, probably income tax guys would not be happy and they might tell you it is a prior period item. So that decision has to be done today. That decision cannot be postponed further for 2 years or 3 years to decide what will be the fate. If you're claiming the credit, you have to fight it out till the end. If you don't want to claim the credit, then subsequently do not have that confusion in mind that I want to forego the depreciation and claim the credit. Sale of fixed asset, what am I supposed to do? Answer is very simple. In case of the sale of fixed asset, you don't have to only pay tax on the sale value, but you have to follow the provisions of 18(6) also and do a proportionate reversal. So on capital goods, if you have claimed the credit and the sale of those capital goods is before the end of 5 years, don't just pay tax on the output supplies. Look at the provision of 18(6) also, and you're required to pay tax in that regard also. Okay. I'll take last 2-3 things before I conclude, and then we'll have question answer session. Exports, there are a lot of compliance that needs to be looked at the year end. First, LUT you have to file for the next year. So that is one check mark that needs to be taken care of. 23-24 is that year where to qualify something as export of goods also, you have to ensure that you receive the foreign currency within 9 months. That is the FEMA time limit plus additional time as allowed in FEMA. If you don't receive that amount, even if you have not claimed the refund, you will be forced to pay IGST and interest on that. So ensure that you're receiving the amount both in terms of goods and services. Otherwise, you will be required to pay tax. Once you will receive the amount, then you will be only allowed to claim the refund of tax, but the interest will be a part of the cost. If you are issuing any debit note in terms of supply of goods or services, along with IGST, pay the tax and then file a refund of it. If you are prepared an invoice and goods have not been dispatched within 3 months, at the year end, take a look at all those situations. If the dispatch has happened beyond 3 months, write to the jurisdictional commissioner and seek an extension. Otherwise, it is a case where under 96A, you will be required to pay tax along with interest. If you are a person who has made supplies to a merchant exporter, ensure to it that merchant exporter has given you all the documents. Those documents are submitted to a jurisdictional officer, and also the shipping bill issued by the merchant exporter has your name along with GST details. If your case is falls under 9610, where you're beneficiary of a customs notification in terms of the purchases, ensure and see to it that you are making an IGST supply subject to the condition that you have paid tax on your imports. If you have not paid tax on your imports, maybe it is a time for you to decide whether you want to forego the benefit at the purchases, want to pay IGST along with interest, and then want to retain the benefit of the refund, or you want to give away the refund and then want to claim the recredit of it. If you are making supplies to an SEZ, see to it that all the invoices have endorsement of it, that all the supplies are for the authorized operation of the SEZ. There is a website called SEZ Online. If you have supplied services to the SEZ, all SEZ services that are listed on the SEZ Online portal, see to it that it is there on the SEZ portal. Otherwise, it will not be treated as a zero rated supplies. So all are these compliances that are in respect of exports at the year end. You have to see to it that it needs to be done. Okay, we have 2 questions. Arjunji has raised a question. Can we claim ITC on expenses converted to capital goods? Yes, why not? Till the time they are goods, there is absolutely no problem. You can claim credit. If it becomes part of an immovable property, which is not plant and machinery, then there is a problem. Otherwise, there is no. There is one question from Shubham. Export was made to A, but payment was received from B. You can do so. So there is a concept for FIRC and BRC. That is a bank clearance certificate you have to get, bank realization certificate. If you are able to demonstrate to the bank that the payment has been made by B on behalf of A, and bank allows it as per the RBI guidelines, then there is no problem. But if you're not able to demonstrate that, bank denies you to issuing a BRC or FIRC to you, then there is a problem. Then department, at least refund they will not give to you. Export, at the end of it, you may still be able to substantiate that you have made the export because at least the foreign currency has been received. But again, it will be a litigative situation. Okay. Reconciliations. I think all of us are aware of what are the reconciliation that needs to be done. Outer time limit is very clear. That is 30th of November for your 16.4 time limit, credit note time limit, correction in GSTR 1, correction in GSTR 3B, and for in respect to TCS correction. Mind you, for ITC reversal under Rule 42 and 43, the time limit is still 30th of September. It is not 30th of November. So if you're making an exempt supply and you do the reversal without interest has to be done by the GSTR 3B filing of March. There is an extended time limit of 6 months which is given to you. That is GSTR 3B filing for the month of September. You can do the reversal along with interest for 6 months. If you want to reclaim the credit you have excess reverse and you want to reclaim it, the GSTR 3B due date of September is the last date where you can reclaim it. Otherwise, that reclaim would not be allowed to you. In your income side, if you have sale of investments, sale of mutual fund, sale of shares, derivatives, futures, options, remember it is not leviable to GST, but the 1% value of it becomes part of your exempt supplies. and on the basis of it, you will do the reversal. Reversal is contained in Rule 43. I will not go into detail. It has a formula which uses various terms. The point is what you have to do at the year end. At the year end, you have to identify the common services. And what is the mechanism to it? This is the illustration of it. Where against your each inward supply on which you are claiming the credit, you are able to give an acronym. You are able to write whether it is T1, T2, T3, T4, or C1, or whatever it is. Only your common credit you are supposed to do a reversal if it is related to your overall business. Otherwise, you cannot stop department for treating your complete ITC as your common credit, and then you will be in the hands of department with a big show cause notice because you have not maintained your records properly. So at the year end, with your ITC register, if you are making an exempt supply, it makes a lot of sense to actually giving this classification or tagging against your inward supplies. That will be quite useful and is sufficient for you to identify whether that reversal which you have done is proper or not. Last is the cross charge and ISD. I think at the year end, these cross charge transactions, that is on which now we have a lot of circular, whether a head office is giving services to a branch giving services to the head office. In all these cases, whether it is an ISD situation or a cross charge situation, up till now the circular says, issued by government, it says if the recipient is able to claim full credit, no problem, don't do a cross charge. Going forward, situation may not remain same. In fact, going forward, what government is saying is you look at ISD and you see to it whether ISD is compulsory on you or not. There is one notion which says ISD is compulsory for everybody who has more than one registration. My understanding is slightly different from the general understanding. You have to still see to it whether whatever you're receiving as goods and services, only the invoice has been received by this particular GSTN, but the benefit of it or service has actually been utilized by some another office. If that has happened, then yes, ISD is mandatory. Otherwise, ISD is not mandatory. Cross charge, that is a supply by one registration to another registration. That depends whether you're able to identify the activity. Go back to my initial slide where I had explained the difference between income and supply. If you are able to identify the activity, then yes, cross charge is required even without consideration. But if activity is not there, then the cross charge is not required. Valuation, government has always given that benefit under Rule 28 Sub Rule 2, where they say if recipient is eligible to full credit, no problem, determine whatever value you want to decide. It is always suggested to have some value and do a cross charge rather than doing nothing, because doing nothing may involve a lot of scrutiny. But yes, you have to identify the activity and then do a cross charge accordingly. I'm sure I'll share this presentation so you'll be able to go through all these basics. So I'm not repeating whatever is mentioned in it. But the important aspect that needs to be taken is that this cross charge is not only applicable for distinct person, it is applicable for related parties also. So what happens is in case of a company, we draw this related party annexure where we write all these details. In short way, that in respect of all these transactions, proper GST compliance is also being taken care of, because this is data which will serve to the department on the basis of your financial statements, and on the basis of it they will raise questions accordingly. So this is one area that needs to be taken care of. So with this, I would like to sum up that there are a lot of activities at the year end which you have to do. I thought I'll be able to put some 15-20 activities which are relevant, which are important, which have a long lasting impact, because all of us have been complying and closing our books of account on a yearly basis. So something extra from what you have been doing, probably that could be helpful, and it will help you at least at the year end to fight your case out, because notice will definitely come. You can't say that notice will not come. Notice will definitely come. It is just for you to see how you contest the matter. So again, thank you ACA for giving me this wonderful opportunity. If there are any questions, I'll be very happy to take those questions.
Thank you, Yash Bhaiya, for this wonderful deliberation. The most important part of this deliberation was that the granular details or the minute details that we as professionals we generally forgot in the midst of, let's say, a bigger compliances. Okay, like the document sees, the reverse charge, self-generated invoices. So what problem they can pose to us in future? So that was very great. So we'll just so let's wait for 5 minutes for this question answer. So So we have Deepak Dhanuka who is selling. So please
Yeah,
elaborate cross charge some more.
right.
So
So the point is, in terms of cross charges, law says that if you are two distinct persons and there is supply of any goods and service happening without consideration, then you have to charge tax. In terms of goods, all of us are very clear when goods are moving from one GST into another GST in same pan, there will be e-way bill. So that e-way will have a tax invoice and tax will move from one GST to another. The problem happens in terms of services because services are all intangible in nature. So whether I've given a service, I've not given a service, because the identification of service actually happens from flow of money. So it's the other way around. Best example, your relative comes to you and tells you to file income tax return. If you do it free of cost, you've not given any service to him. You have just respected him. But if you charge him, suddenly you have given a service to him. Now, in law says that if due to your relationship and due to your multiple registrations, if you're not charging, still you have to pay GST on it. So the aspect is that needs to be taken care at the year end is, which you will not find in your books of account, is to sit down and identify the flow of transaction which takes from one GST into another. Meaning thereby, if let's say you have categorized one of the GSTs as head office, corporate office, registered office, where management is sitting, where all the services are received, which are centralized procurement team, centralized accounting team, centralized legal team are sitting. Are they giving any services to the branches? That is to be identified. Well, now the answer is very tricky. It can have multiple facets to it. The answer to I think the best way to answer that is look at from the law. Law supports you if it says if recipient is able to claim in full input tax credit, then in that case you can have any value on the invoice and we will not question the invoice. Then in that case, have a cross charge policy document duly signed by the management where you identify that my head office has done this activity for my branches. It can be accounting support, it can be management support, it can be business support. Now you may tell me that I'm telling you to generate a fake document. It's not the case. What I'm telling you is that your head office is doing all these activities. The only problem is you are not able to identify whether a head office is doing for itself or it is doing for the branches. But once you document it by saying that we have understood that my head office is doing this activity for my branches, and I'm attributing this value on the basis of Rule 28, second proviso to Rule 28, then in that case, it will be very difficult for department to say, no, this is incorrect. But if you don't do anything and tomorrow department asks this question, what is your head office doing for the branches, and you give similar sort of an answer, then it somehow creates a problem. It becomes a problematic situation for you, and how will you defend it? So answer to all of this in terms of cross charges, have a cross charge policy document at the year end, duly signed by the management. If the management is good enough, the board meetings are proper, put it in a board meeting, make it part of a board minutes, document it, and then say that on the basis of it we have done the cross charge. That will be very helpful for you to contest the matter in the times to come. Okay. Ranveer ji has asked a question whether cross charge is mandatory for internally generated services like HO staff working for branch even after ISD mandatory amendment by interim budget of February notified few days back. Ranveer ji, question is slightly on the whether ISD cross charge. One aspect which I have clarified from my side is, according to me, ISD is not mandatory. It is still on the basis of case to case, depending upon how invoices are flowing. Okay, so it is not that if I have more than one registration, I have to compulsory take ISD. That's not how I look at it. I might be contradicted by others, but that's my view. So if I'm able to identify that there are certain activities which has been done by the head office for the branches, clearly ISD is not the route for it. Only supply of service by head office to branch is the route for it. Now, whether that activity is only receiving of the invoice from third party and passing it on, then it is ISD. But if it is something an activity is self-generated or maybe supporting the other third party, plus doing some activity from my side and doing for the branches, that is cross charge. So it is on case to case basis how you identify it. The answer to that again, to according to me, is that an identification will be on the basis of how have you documented. If your documentation is proper, it will be very difficult for the department to actually contradict that. I hope I was able to make some sense to that the question which you asked.
I'll just take this opportunity to present you with the e-memento. Um, for your contribution to the AC litigation series.
Thank you.
And yeah, but yeah, I just had a doubt.
Yes.
So yeah. So what is this? So we have a client, so that is dealing in the both exempted and taxable products. Okay, and that too, the product is perishable in nature.
Okay.
Okay, so what has happened is that let's say within the first 3 quarters, so the client has made sale of let's say 5 CR plus.
Okay.
Okay, but in the last quarter, that is the quarter 4, what happened that the materials that were supplied in the quarter 2 or quarter 3, they were defective or let's say perished.
Okay.
Okay, so accordingly, in the quarter 4, the credit notes were issued. Okay, and this credit notes comprised of both taxable and exempted goods. Okay, and also in case of B2B and B2C.
Okay.
Okay, so what has happened is that when the GSTR1 for the quarter 4 is being filed, so the B2 B2C figures in case of the exempt supplies is coming in negative. Okay, because the credit note issued is more and the supplies are less. Now,
Correct.
what has happened is that when the return has been filed, okay, now my books is let's say showing a sales of 4.9 CR after adjusting all the credit note. But when I am let's say looking into 20s AIS, that is where the summary of GSTR 3B returns filed is showing. Now it is showing sales of 5.1 CR. It is
Correct.
not taking into account the negative exempt supplies that I have reported in my GSTR1.
Correct.
Now, so whether it can create a litigation for this e-invoicing, because the department is having now an information that the client's turnover is 5.1 CR, but in my books it is fully reconciled and it is around 4.9 CR.
Absolutely right. So you're right. So what happens is actually they take data not always from GSTR1, they take data from GSTR3B. Now problem is in your GSTR3B, you do not have a negative data. You can't
Yes,
punch negative data.
exactly.
The higher figure.
Yes.
Now, because that goes beyond 5 crores, and now, as I was saying in the starting, sometimes you have to surrender yourself to the system. So, if system says that you have enabled yourself for e-invoicing, because it is a compliance that needs to be done, unfortunately, the answer will be that you should do the e-invoicing compliance because you can't fight it out. It will be very difficult for the officer even to say, okay, how can I go back to the e-invoicing team and tell them that e-invoicing is not applicable here? So
Okay.
my again legal answer is e-invoicing not applicable. Practical answer is because it is just a compliance, it is not costing you anything extra apart from having that e-invoicing setup. You should do that.
Okay. So I think, Bhaiya, there is no more question. So we can conclude this webinar as of now. So thanks a lot for your wonderful deliberation on this topic. We learned a lot today. Okay, and we'll just take it into account our practice.
Yeah, my pleasure. Thank you so
Yeah.
much.